Let's kick things off with insurance fundamentals. You'll answer realistic, scenario-based questions designed to help you think like the exam and build confidence from the very beginning. After a fire damages her bakery, Maria files a claim with her insurer, but the insurer discovers she intentionally set the fire. Which insurance principle allows the insurer to deny her claim in this situation? Is it A, utmost good faith, B, insurable interest, C, contribution, or D, subrogation? The correct answer is A, utmost good faith. The principle of utmost good faith requires both parties to act honestly. Since Maria committed fraud, the insurer can deny the claim based on this principle. When Tom insures his neighbor's car without owning it or suffering a loss if it is damaged, which principle is violated in this insurance arrangement? Is it A, indemnity, B, insurable interest, C, proximate cause, or D, subrogation? The correct answer is B, insurable interest. The principle of insurable interest requires the policyholder to have a financial stake in the insured item. Tom lacks this, making the contract invalid. After a storm damages his home, Alex receives full compensation from two different insurers for the same loss. Which principle prevents him from profiting in this way? Is it A, utmost good faith, B, insurable interest, C, indemnity, or D, contribution? The correct answer is C, indemnity. The principle of indemnity ensures that the insured is restored to their original financial position but cannot profit from a loss. If an insurer pays out a claim for a car accident caused by a third party, which principle allows the insurer to recover the amount from the responsible third party? Is it A, contribution, B, insurable interest, C, indemnity, or D, subrogation? The correct answer is D. The principle of subrogation allows the insurer to step into the insured's shoes and recover the claim amount from the party at fault. When a policyholder with two fire insurance policies on the same property files a claim, which principle ensures that each insurer pays only their fair share of the loss? Is it A, subrogation, B, contribution, C, indemnity, or D, utmost good faith? The correct answer is B, contribution. The principle of contribution ensures that when multiple policies cover the same risk, each insurer pays a proportionate share to prevent overcompensation.
How'd you do on the first 5 questions? Go ahead and subscribe to Birdsy now and turn your progress into exam day confidence. Ready to jump back in? Let's go.
After a severe hailstorm damages his insured home, David files a claim, but the insurer discovers he failed to disclose a previous roof repair when applying for the policy. Which insurance principle allows the insurer to deny his claim due to this omission? Is it A, principle of indemnity, B, principle of utmost good faith, C, principle of subrogation, or D, principle of contribution? The correct answer is B, principle of utmost good faith. The principle of utmost good faith requires applicants to fully disclose all material facts. Failing to do so allows the insurer to deny the claim because the contract was based on incomplete or misleading information. Insurance contracts. After purchasing a life insurance policy, Maria receives a document outlining the terms, coverage, and exclusions. Which part of the insurance contract does this document represent? Is it A, application, B, policy, C, rider, or D, binder? The correct answer is B, policy. The policy document is the written contract that details the terms, coverage, and exclusions, making it the definitive source for what is covered and under what conditions. When an insurance company discovers that John misrepresented his smoking status on his health insurance application 2 years after the policy was issued, which contract principle allows the insurer to void the contract? B. Utmost good faith. C. Material misrepresentation. Or D. Insurable interest. The correct answer is C. Material misrepresentation. Material misrepresentation allows the insurer to void the contract if the false information would have affected the underwriting decision, even after the policy is issued. If an insured files a claim for a loss that occurred before the policy was issued, which insurance contract characteristic will the insurer most likely cite to deny the claim? Is it A. Aleatory, B. Adhesion, C. Unilateral, or D. Conditional? The correct answer is D. Conditional. Insurance contracts are conditional, meaning coverage only applies to losses that occur during the policy period, so losses before issuance are not covered. Samantha adds a waiver of premium provision to her disability insurance policy. What is the effect of this addition on her insurance contract? Is it A. It adds a rider that modifies the policy terms, B. It replaces the entire policy with a new contract, C. It cancels the policy and refunds premiums, or D. It removes all exclusions from the policy? The correct answer is A. It adds a rider that modifies the policy terms. A waiver of premium is a rider which modifies the original contract by adding specific benefits or provisions, often for an additional cost.
If you want more than just rapid-fire questions, head over to Birdsy.ai. You can take unlimited practice exams and get instant help from your personal AI study partner. It's like having a tutor 24/7. Try it free. You'll find a link in the description.
When an insurance agent accepts the initial premium and issues a conditional receipt to a new applicant, what is the legal effect on the insurance contract if the applicant dies before the policy is formally issued? Is it A. No coverage exists until the policy is delivered, B. Coverage may exist if the applicant qualified under the insurer's rules at the time of application, C. The agent is personally liable for the claim, or D. The contract is void due to the applicant's death? The correct answer is B. Coverage may exist if the applicant qualified under the insurer's rules at the time of application. A conditional receipt provides temporary coverage if the applicant meets the insurer's underwriting requirements at the time of application, so the insurer may be obligated to pay if those conditions are satisfied. After losing his job, David stops paying premiums on his health insurance policy and receives a notice from the insurer stating his coverage will end in 30 days unless payment is made. Which insurance contract provision is being exercised in this situation? Is it A. Incontestability clause, B. Entire contract provision, grace period provision, or D. Misstatement of age provision? The correct answer is C. Grace period provision. The grace period provision allows policyholders a set amount of time to pay overdue premiums before the policy lapses, which is what David is experiencing after missing his payment. Insurable interest, risk, and underwriting. After purchasing a life insurance policy on her business partner, Maria is asked by the insurer to provide documentation proving her financial relationship to the partner. What is the insurer primarily seeking to confirm in this underwriting step? Is it A. That Maria has an insurable interest in her business partner's life, B. That Maria is the sole beneficiary of the policy, C. That Maria's partner has no other insurance policies, or D. That Maria's partner is in good health? The correct answer is A. that Maria has an insurable interest in her business partner's life. The insurer is verifying insurable interest, which is required at the time of policy issuance to ensure Maria would suffer a financial loss if her partner died. When reviewing an application for auto insurance, the underwriter notices the applicant has a history of multiple speeding tickets in the past year. What is the underwriter most likely to do based on risk assessment principles? Is it A, approve the policy at the standard rate, B, increase the premium or impose stricter policy terms, deny the application automatically, or D, ignore the violations if the applicant has no claims history? The correct answer is B, increase the premium or impose stricter policy terms. A history of traffic violations indicates higher risk, so the underwriter may charge a higher premium or apply stricter terms to reflect the increased likelihood of a claim. A landlord purchases property insurance for an apartment building, but later sells the building to a new owner without updating the policy. What issue arises regarding insurable interest if a fire damages the building after the sale? Is it A, the landlord can still claim because the policy is active, B, both the landlord and new owner can file claims, C, the landlord cannot claim because they no longer have insurable interest, or D, the insurer will pay the claim to the new owner automatically? The correct answer is C, the landlord cannot claim because they no longer have insurable interest. Once the landlord sells the building, they no longer have an insurable interest, so they cannot claim for damages that occur after the sale.
Have you noticed the code in the bottom corner? The next time you're stumped, take that code to birdsy.ai. You'll get immediate help, complimentary study sessions, and access to hundreds of additional questions. It's the best tool to help you pass with confidence.
During the underwriting process for a health insurance policy, an applicant omits a recent hospitalization from their medical history. What is the most likely consequence if the omission is discovered before the policy is issued? B, the insurer will ignore the omission if the applicant is otherwise healthy. C, the applicant will be charged a higher premium automatically. Or D, the insurer may decline to issue the policy or change the terms. The correct answer is D, the insurer may decline to issue the policy or change the terms. If material information is withheld, the insurer may decline to issue the policy or adjust the terms, as accurate disclosure is essential for proper risk assessment. A couple applies for joint life insurance, but the underwriter notes that only one spouse earns an income and the other has no financial dependence. Under the principle of insurable interest, what is the underwriter most likely to consider? Is it A, whether the applicant would suffer a financial loss if the non-earning spouse dies? B, whether both spouses are of similar age? C, whether the non-earning spouse has a medical condition? Or D, whether the couple has been married for more than 5 years? The correct answer is A, whether the applicant would suffer a financial loss if the non-earning spouse dies. Insurable interest requires a financial loss upon the insured's death. The underwriter will consider whether the non-earning spouse's death would cause such a loss to the applicant. After inheriting a valuable painting, Olivia applies for property insurance on it, but the insurer asks her to provide proof of ownership and value before issuing the policy. What is the insurer aiming to verify during underwriting in this situation? Is it A, that Olivia has an insurable interest in the painting? B, that Olivia intends to sell the painting soon? C, that the painting is covered by another insurance policy? Or D, that Olivia has a history of filing insurance claims? The correct answer is A, that Olivia has an insurable interest in the painting. The insurer is seeking to confirm Olivia's insurable interest in the painting, ensuring she stands to suffer a financial loss if it is damaged or destroyed, which is a fundamental requirement for issuing property insurance. Now, let's move into life insurance. These realistic scenario-based questions will help you apply key concepts, recognize common policy features, and prepare for the kinds of situations you'll encounter on the exam. Types of life insurance policies. Maria wants a life insurance policy that will provide coverage for her entire life and accumulate cash value she can borrow against in the future. So which type of policy best fits her needs? Is it A, term life insurance, B, whole life insurance, C, accidental death insurance, or D, group life insurance? The correct answer is B, whole life insurance. A whole life policy offers lifelong coverage and builds cash value that can be borrowed against, making it suitable for Maria's goals. After reviewing his budget, James decides he needs the most affordable life insurance option to cover his mortgage for the next 20 years. So which policy type should he consider? Is it A, term life insurance, B, universal life insurance, C, variable life insurance, or D, endowment policy? The correct answer is A, term life insurance. Term life insurance is generally the most affordable and is ideal for temporary needs like covering a mortgage for a specific period. Samantha wants a life insurance policy that allows her to adjust her premium payments and death benefit as her financial situation changes. So which policy type should she select? Is it A, whole life insurance, B, term life insurance, C, universal life insurance, or D, credit life insurance? The correct answer is C, universal life insurance. Universal life insurance offers flexible premiums and adjustable death benefits, making it ideal for someone with changing financial needs. David is interested in a life insurance policy that allows him to invest the cash value in various sub-accounts, accepting the risk for potential higher returns. So, which policy should he choose? Is it A, term life insurance, B, whole life insurance, C, universal life insurance, or D, variable life insurance? The correct answer is D, variable life insurance. Variable life insurance allows policyholders to invest the cash value in sub-accounts, offering potential for higher returns, but with investment risk. A company wants to provide basic life insurance coverage to all its employees as a workplace benefit. So which type of policy is most commonly used in this situation? Is it A, group life insurance, B, endowment policy, C, variable life insurance, or D, universal life insurance? The correct answer is A, group life insurance. Group life insurance is typically offered by employers to provide basic coverage to employees under a single contract. When Priya wants a life insurance policy that guarantees a fixed premium and death benefit for her entire life, but does not allow her to change the coverage amount, which type of policy should she choose? Is it A, whole life insurance, B, universal life insurance, C, term life insurance, or D, variable life insurance? The correct answer is A. A whole life policy provides lifelong coverage with fixed premiums and a guaranteed death benefit, but does not allow for changes in coverage amount, fitting Priya's needs. Carlos is looking for a life insurance policy that will cover him for a specific period and pay a benefit only if he dies during that time. So which type of policy should he purchase? Is it A, whole life insurance, B, term life insurance, C, universal life insurance, or D, endowment policy? The correct answer is B, term life insurance. Term life insurance provides coverage for a set period and pays a benefit only if the insured dies within that time frame, which matches Carlos's needs. Elena wants a life insurance policy that combines lifelong protection with the opportunity to earn a variable cash value based on investment performance, So which policy type should she consider? Is it A, term life insurance, B, whole life insurance, C, variable life insurance, or D, group life insurance? The correct answer is C, variable life insurance. Variable life insurance offers permanent coverage and allows the cash value to be invested in subaccounts, so the value can fluctuate with investment performance. After a recent promotion, Marcus wants a life insurance policy that lets him increase his death benefit and adjust his premium payments as his income grows. So which policy should he choose? Is it A, term life insurance, B, whole life insurance, C, variable life insurance, or D, universal life insurance? The correct answer is D, universal life insurance. Universal life insurance allows policyholders to adjust both the death benefit and premium payments, making it suitable for Marcus's changing financial situation. A small business owner wants to buy a life insurance policy that will pay a benefit if she survives a certain number of years or dies within that period. So which type of policy should she select? Is it A, whole life insurance, B, endowment policy, C, universal life insurance, or D, term life insurance? The correct answer is B, endowment policy. An endowment policy pays out either at the end of a specified period if the insured survives, or upon death during that period, fitting the business owner's needs. Policy provisions, options, and riders. After being diagnosed with a serious illness, Maria wants to access a portion of her life insurance policy's death benefit while still alive. Which policy provision allows her to do this? Is it A, waiver of premium rider, B, guaranteed insurability option, C, accelerated benefit rider, or D, accidental death benefit rider? The correct answer is C, accelerated benefit rider. The accelerated benefit rider allows policyholders to receive part of the death benefit early if diagnosed with a qualifying terminal or serious illness, providing financial support during their lifetime. When reviewing his life insurance policy, James notices a clause that allows him to reinstate his lapsed policy within a certain period if he provides evidence of insurability and pays back premiums. What is this provision called? Is it A, incontestability clause, B, reinstatement provision, C, grace period provision, or D, misstatement of age provision? The correct answer is B, reinstatement provision. The reinstatement provision allows a lapsed policy to be restored within a specified period, provided the policyholder meets certain requirements like paying back premiums and proving insurability. Samantha wants to ensure her life insurance policy remains active even if she becomes totally disabled and cannot pay premiums. Which rider should she select to achieve this protection? Is it A, waiver of premium rider, B, pay or benefit rider, C, return of premium rider, or D, cost of living rider? The correct answer is A, waiver of premium rider. The waiver of premium rider ensures that if the insured becomes totally disabled, the insurer will waive future premium payments, keeping the policy in force. After her husband's death, Linda chooses to receive the life insurance proceeds in regular monthly payments for as long as she lives, rather than a lump sum. B, fixed period option, C, fixed amount option, or D, life income option? The correct answer is D, life income option. The life income settlement option provides regular payments to the beneficiary for their lifetime, rather than a single lump sum payment. When applying for a new life insurance policy, Tom is told that the policy will not cover death by suicide within the first 2 years. What is the purpose of this policy provision? Is it A, Misstatement of age clause. B. Suicide clause. C. Incontestability clause. Or D. Grace period provision. The correct answer is B. Suicide clause. The suicide clause limits the insurer's liability for suicide within a specified period, usually 2 years, to prevent adverse selection and protect the insurer from immediate large claims. After losing his job, Brian is unable to pay his life insurance premiums but wants to keep some coverage in force without making further payments. Which non-forfeiture option allows him to use the policy's cash value to purchase a reduced amount of paid-up insurance? Is it A. Extended term insurance, B. Reduced paid-up insurance, C. Automatic premium loan, or D. Waiver of premium rider? The correct answer is B. Reduced paid-up insurance. The reduced paid-up insurance option uses the policy's cash value to buy a smaller, fully paid-up policy, allowing Brian to maintain some coverage without future premium payments. When applying for a life insurance policy, Carla is asked to name a person who will receive policy benefits if her primary beneficiary dies before her. What is the role of this person in the policy? Is it A. Policy owner, B. Irrevocable beneficiary, C. Contingent beneficiary, or D. Assignee? The correct answer is C. Contingent beneficiary. A contingent beneficiary receives the policy proceeds if the primary beneficiary is deceased at the time of the insured's death, ensuring the benefits are paid according to Carla's wishes. During a policy review, Mr. Lee discovers that his life insurance policy allows him to increase the face amount at certain intervals without providing evidence of insurability. Which rider provides this feature? Is it A. Accidental death benefit rider, B. Cost of living rider, C. Return of premium rider, or D. Guaranteed insurability rider? The correct answer is D. Guaranteed insurability rider. The guaranteed insurability rider allows the insured to purchase additional coverage at specified times without proof of insurability, protecting against future health changes. Policy ownership, beneficiaries, and settlement options. After divorcing his spouse, Mark forgets to update the beneficiary on his life insurance policy and later passes away. Who will receive the policy proceeds in this situation? Is it A. His ex-spouse as the named beneficiary, B. His children as next of kin, his estate since he is divorced, or D. His current partner if named in his will? The correct answer is A. His ex-spouse as the named beneficiary. Unless Mark updated his beneficiary designation, the original named beneficiary, his ex-spouse, remains legally entitled to the proceeds, regardless of their changed relationship status. Samantha owns a life insurance policy on her business partner and names herself as beneficiary, but her partner pays all the premiums. Who has the right to change the beneficiary designation? Is it A. The insured business partner, B. Samantha as the policy owner, C. Both must agree to any changes, or D. The insurance company? The correct answer is B. Samantha as the policy owner. The policy owner, in this case Samantha, has all contractual rights, including changing the beneficiary, regardless of who pays the premiums. When Maria dies, her life insurance policy pays the death benefit in a lump sum to her primary beneficiary, but the beneficiary wants to receive regular payments instead. What must happen for this change in settlement option? Is it A. The insurer automatically offers all options at payout, B. The policy owner must have selected the option before death, C. The beneficiary must request the change before the payout is made, or D. The estate executor decides the payout method? The correct answer is C. The beneficiary must request the change before the payout is made. The beneficiary may choose a different settlement option if the policy allows, but must notify the insurer before proceeds are paid out. Once paid, the option cannot be changed. If a policy owner names her minor child as the sole beneficiary of her life insurance policy and then dies unexpectedly, what typically happens to the policy proceeds? Is it A, the proceeds are paid directly to the minor child? B, the funds are held by the insurance company until the child turns 18. C, the proceeds are forfeited to the state until the child is an adult. Or D, a court-appointed guardian or trustee manages the funds until the child is of legal age. The correct answer is D. A court-appointed guardian or trustee manages the funds until the child is of legal age. When a minor is named as beneficiary, the insurer usually pays the proceeds to a court-appointed guardian or trustee until the child reaches legal age. David names his wife as the primary beneficiary and his brother as the contingent beneficiary on his life insurance policy. If both his wife and brother predecease him, who will receive the death benefit when David dies? Is it A, David's estate? B, the insurance company retains the funds? C, David's children automatically? Or D, the state unclaimed property fund? The correct answer is A, David's estate. If both primary and contingent beneficiaries have predeceased the insured, the policy proceeds are paid to David's estate. Linda owns a life insurance policy and names her adult son as the primary beneficiary. But after Linda's death, it is discovered that her son predeceased her and no contingent beneficiary was named. Who will receive the policy proceeds in this case? Is it A, Linda's insurance agent? B, Linda's adult son's heirs? C, Linda's estate? Or D, the insurance company retains the proceeds? The correct answer is C, Linda's estate. If the primary beneficiary is deceased and no contingent beneficiary is named, the policy proceeds are typically paid to Linda's estate, as there is no living beneficiary designated to receive the benefit. After purchasing a life insurance policy, Carla assigns ownership of the policy to her adult daughter, but continues to pay all the premiums herself. Who now has the legal right to change the beneficiary designation on the policy? Is it A, Carla as the original policy owner? B, Carla's daughter as the new policy owner? C, the insurance company? Or D, the current beneficiary? The correct answer is B, Carla's daughter as the new policy owner. Once Carla assigns ownership to her daughter, the daughter becomes the policy owner and gains all rights associated with ownership, including the right to change the beneficiary. Premiums, cash value, loans, and dividends. Maria has a whole life insurance policy and wants to use the accumulated cash value to pay her premium this year after a temporary loss of income. What policy feature allows her to do this without losing coverage? Is it A, automatic premium loan provision? B, dividend option? C, paid-up additions? Or D, extended term insurance? The correct answer is A, automatic premium loan provision. The automatic premium loan feature allows Maria to use her policy's cash value to pay premiums if she cannot, preventing a lapse in coverage as long as sufficient cash value remains. After 10 years, John's participating whole life policy has accumulated significant dividends, and he wants to use them to reduce his annual out-of-pocket premium payment. Which dividend option should he select? Is it A, purchase paid-up additions? B, reduce premium payments? C, accumulate at interest? Or D, take dividends in cash? The correct answer is B, reduce premium payments. The reduce premium payments dividend option allows John to apply his dividends directly toward his annual premium, lowering his out-of-pocket cost each year. Lisa needs emergency funds and considers borrowing from her universal life insurance policy's cash value. What is one key consequence she should be aware of if she does not repay the loan? Is it A, her premiums will automatically increase? B, the policy will immediately lapse? C, the death benefit will be reduced by the loan amount? Or D, she will lose all accumulated dividends? The correct answer is C, the death benefit will be reduced by the loan amount. If Lisa does not repay the loan, the outstanding balance plus interest will be deducted from the death benefit paid to her beneficiaries, reducing the amount they receive. Tom is reviewing his variable life insurance statement and notices the cash value has decreased this year. What is the most likely reason for this change? Is it A, he missed a premium payment? B, the insurer increased the policy fees? C, he took a policy loan? Or D, the underlying investments performed poorly? The correct answer is D, the underlying investments performed poorly. Variable life insurance cash value fluctuates with the performance of underlying investment options, so a decrease is most likely due to poor investment returns in the selected accounts. Samantha's whole life policy has accumulated enough cash value for her to consider a reduced paid-up insurance option. What will happen if she chooses this option? Is it A, she will have a lower death benefit with no further premiums due? B, her policy will be converted to term insurance for the original face amount? C, she will receive the cash value in a lump sum and lose coverage? Or D, her premiums will be suspended temporarily but resume later? The correct answer is A, she will have a lower death benefit with no further premiums due. Choosing the reduced paid-up option means Samantha will stop paying premiums and her policy will continue with a lower death benefit, fully paid up for life, using the existing cash value. After receiving an annual statement, Priya notices her whole life insurance policy's cash value has grown, and she is considering taking a policy loan to help fund her daughter's college tuition. What is a key feature of this loan that distinguishes it from a traditional bank loan? B, no credit check is required, and repayment terms are flexible, but unpaid loans reduce the policy's death benefit. C, the loan is tax-free only if repaid within 5 years. Or D, the loan can only be used for medical expenses. The correct answer is B, no credit check is required, and repayment terms are flexible, but unpaid loans reduce the policy's death benefit. A policy loan from a life insurance policy does not require credit approval or repayment on a set schedule, but interest will accrue, and unpaid loans reduce the death benefit. Carlos owns a participating whole life insurance policy and receives a notice that the insurer has declared a dividend this year. If he chooses the paid-up additions option, what will happen to his policy? Is it A, his future premiums will be reduced by the dividend amount? B, he will receive the dividend as a cash payment? C, the dividend will buy extra permanent insurance, increasing his policy's death benefit and cash value? Or D, his policy will be converted to term insurance for the dividend amount? The correct answer is C, the dividend will buy extra permanent insurance, increasing his policy's death benefit and cash value. Selecting the paid-up additions option uses dividends to purchase additional amounts of permanent insurance, increasing both the policy's death benefit and cash value without requiring extra premium payments. Now it's time for health insurance. You'll work through realistic, scenario-based questions covering health plans, policy provisions, and the situations you're likely to encounter on the licensing exam. Individual and group health insurance. After losing his job, Mark is offered the option to continue his group health insurance coverage under COBRA for up to 18 months. What is the primary requirement he must meet to maintain this coverage? Is it A, he must pay the full premium plus an administrative fee? B, he must enroll in a new individual plan within 30 days? C. He must provide proof of insurability to the insurer. Or D. He must accept a reduced level of benefits. The correct answer is A. He must pay the full premium plus an administrative fee. Mark must pay the full premium plus a small administrative fee to continue his group health insurance under COBRA, as the employer no longer subsidizes the cost after employment ends. When Maria joins a new company, she is told there is a 90-day waiting period before her group health insurance coverage begins. What is the main purpose of this waiting period? Is it A. to allow time for pre-existing condition exclusions to be applied? B. to reduce employer costs by limiting coverage to long-term employees? C. to comply with state-mandated open enrollment periods? Or D. to give employees time to choose between multiple health plans? The correct answer is B. to reduce employer costs by limiting coverage to long-term employees. The waiting period helps employers manage risk by ensuring only committed employees receive coverage, reducing administrative costs for short-term hires. Leela, who is self-employed, wants to purchase an individual health insurance policy and is concerned about coverage for pre-existing conditions. What protection does the Affordable Care Act provide in her situation? Is it A. insurers can impose a 12-month waiting period for pre-existing conditions? B. insurers may deny coverage based on health status? C. insurers must offer coverage regardless of pre-existing conditions? Or D. insurers can limit benefits for the first year of coverage? The correct answer is C. Insurers must offer coverage regardless of pre-existing conditions. The Affordable Care Act prohibits insurers from denying coverage or charging higher premiums due to pre-existing conditions, ensuring Lila can obtain coverage regardless of her health history. A small business owner wants to offer group health insurance to her 5 employees and asks about the minimum participation requirements. What is a typical requirement for group health plans in this situation? Is it all employees must enroll regardless of other coverage? B. Only full-time employees are eligible for group coverage? C. The employer must pay 100% of the premiums? Or D. A certain percentage of eligible employees must enroll in the plan? The correct answer is D. A certain percentage of eligible employees must enroll in the plan. Most insurers require a minimum percentage of eligible employees, often 75%, to participate in the group plan to prevent adverse selection. After being diagnosed with a chronic illness, Tom is worried about losing his individual health insurance if he misses a premium payment. What is the standard provision that protects him in this situation? Is it A. A grace period allows continued coverage for a limited time after a missed payment? B. A contestability period allows the insurer to review claims for 2 years? C. A waiting period applies before benefits are paid for chronic illnesses? Or D. A coordination of benefits clause covers missed payments through other insurers? The correct answer is A. A grace period allows continued coverage for a limited time after a missed payment. Most individual health insurance policies include a grace period, typically 31 days, during which coverage remains in force if the premium is late. After moving to a new state, Priya wants to enroll in an individual health insurance plan, but is concerned about whether her previous coverage will help her avoid a new waiting period for pre-existing conditions. What must she provide to ensure continuous coverage without a new waiting period? Is it A. A letter of recommendation from her previous employer? B. A copy of her most recent tax return? C. Documentation of prior creditable health insurance coverage? Or D. A statement from her new doctor? The correct answer is C. Documentation of prior creditable health insurance coverage. To avoid a new waiting period for pre-existing conditions, Priya must provide proof of prior creditable coverage, which demonstrates she was previously insured and prevents a gap in coverage from triggering a new waiting period. When a company merges with another and forms a new group health insurance plan, several employees are worried about losing their current coverage. What federal law requires the new employer to offer continuation of coverage to eligible employees? Is it A, HIPAA, B, COBRA, C, ERISA, or D, Affordable Care Act? The correct answer is B, COBRA. COBRA is the federal law that requires employers to offer continuation of group health insurance coverage to eligible employees after certain qualifying events, including mergers or job loss. Jorge is considering joining a small business that offers group health insurance, but he has a dependent with a serious medical condition. What is the main advantage of group health insurance for covering his dependent's pre-existing condition? Is it A, pre-existing conditions for dependents are covered without exclusion? B, dependents must wait 1 year before coverage begins? C, only the employee is protected from pre-existing condition exclusions? Or D, coverage for dependents is optional and not regulated? The correct answer is A, pre-existing conditions for dependents are covered without exclusion. Group health insurance plans generally cover pre-existing conditions for dependents without exclusion, especially since the Affordable Care Act prohibits such exclusions in group plans.
Did you get a different answer? Or maybe you have a question about the exam in general? Drop it in the comments below. We read and answer them personally.
Medical expense, disability income, and long-term care insurance. After being diagnosed with a chronic illness, Maria's doctor recommends daily in-home nursing care, so she reviews her long-term care insurance policy to determine if these services are covered under her plan's home health care benefits. Is it A, yes, if her policy includes home health care benefits and the care is medically necessary? B, no, long-term care insurance only covers care in licensed nursing facilities? C, only if Maria is under age 65 at the time of claim? Or D, yes, but only if her illness is expected to improve within 90 days? The correct answer is A, yes, if her policy includes home health care benefits and the care is medically necessary. Long-term care insurance policies often include home health care benefits, which typically cover in-home nursing care for chronic illnesses when medically necessary and prescribed by a physician. When Tom, a self-employed graphic designer, suffers a back injury that prevents him from working for 3 months, he files a claim under his individual disability income insurance policy to replace his lost earnings. Is it A, his policy will only pay benefits if he is permanently disabled? B, he will receive benefits for the period he is unable to work, subject to the elimination period and policy limits? C, he must wait until the end of the calendar year to file a claim? Or D, he will not receive benefits because he is self-employed? The correct answer is B, he will receive benefits for the period he is unable to work, subject to the elimination period and policy limits. Disability income insurance is designed to replace a portion of lost income if the insured is unable to work due to a covered illness or injury, as in Tom's situation. After being hospitalized for surgery, Linda receives a bill for several medical expenses, but her health insurance plan only pays a portion, leaving her responsible for the deductible and coinsurance amounts. Is it A, her insurer should pay all expenses related to her hospitalization? B, she only pays for non-covered services, not deductibles or coinsurance? C, she is responsible for the deductible and coinsurance as outlined in her policy? Or D, she can submit the bill to her employer for reimbursement? The correct answer is C, she is responsible for the deductible and coinsurance as outlined in her policy. Health insurance policies typically require the insured to pay a deductible and coinsurance before the insurer covers the remaining eligible expenses, which explains Linda's out-of-pocket costs. When Raj's employer offers a group medical expense plan with a coordination of benefits provision, Raj's spouse, who also has coverage through her own employer, needs to determine which plan pays first if she files a claim. Is it A. Raj's employer's plan will always pay first for his spouse's claims? B. Both plans pay equal amounts regardless of the claim? Or D. The spouse's own employer plan is primary and Raj's employer's plan is secondary? The correct answer is D. The spouse's own employer plan is primary and Raj's employer's plan is secondary. Coordination of benefits provisions determine which plan is primary and which is secondary, so the spouse's own employer plan typically pays first for her claims. After her father suffers a stroke and needs help with bathing and dressing, Emily learns that his long-term care insurance policy will pay benefits because he is unable to perform 2 activities of daily living without assistance. Is it A. Yes, because inability to perform 2 activities of daily living is a common benefit trigger? B. No, because cognitive impairment is the only trigger for benefits? C. Only if the stroke occurred in a nursing facility? Or D. Yes, but only after a 12-month waiting period? The correct answer is A. Yes, because inability to perform 2 activities of daily living is a common benefit trigger. Long-term care insurance benefits are typically triggered when the insured cannot perform at least 2 activities of daily living, such as bathing and dressing, without help. After being laid off from her job, Jessica is offered the option to continue her employer-sponsored health insurance for up to 18 months under COBRA, and she must decide whether to enroll and pay the full premium herself. Is it A. She can continue coverage for up to 36 months at no cost to her? B. She must enroll within 60 days, but will only pay half the premium? C. She can continue coverage for up to 18 months by paying the full premium herself? Or D. She is not eligible for COBRA since she was laid off and not terminated for cause? The correct answer is C. She can continue coverage for up to 18 months by paying the full premium herself. COBRA allows eligible employees to continue their group health coverage for a limited period after job loss, but the individual must pay the entire premium plus a small administrative fee. When Mark, who has a disability income policy with a 90-day elimination period, is unable to work due to an accident, he wants to know when his policy will begin paying benefits. Is it A. Benefits start immediately after he files a claim? B. Benefits begin after he has been disabled for 90 days? C. Benefits start after the insurance company approves his claim, regardless of the elimination period? Or D. Benefits are paid retroactively to the first day of disability once the claim is approved? The correct answer is B. Benefits begin after he has been disabled for 90 days. A 90-day elimination period means Mark must be disabled for 90 days before benefits start. Payments begin after this waiting period is satisfied. After turning 65, George enrolls in Medicare Part A and Part B, but he is surprised to learn that his routine dental and vision care expenses are not covered by his new health insurance. Is it A. Medicare Parts A and B do not cover routine dental or vision care, so George must seek separate coverage for these services? B. Medicare Part B covers all routine dental and vision expenses for enrollees over 65. C. Medicare Part A covers dental and vision care only if provided during a hospital stay? Or D. George can add dental and vision coverage to his Medicare plan at no additional cost? The correct answer is A. Medicare Parts A and B do not cover routine dental or vision care, so George must seek separate coverage for these services. Medicare Parts A and B generally do not cover routine dental or vision care, so George will need separate coverage for these services. Managed care plans and government health programs. After moving to a new state, Maria needs to continue her ongoing cancer treatment and is considering enrolling in a managed care plan. Which plan type would most likely require her to select a primary care physician and obtain referrals for specialist visits? Is it A. Health Maintenance Organization, HMO, B. Preferred Provider Organization, PPO, C. Point of Service, POS plan, or D. Indemnity plan? The correct answer is A. Health Maintenance Organization, HMO. Health maintenance organizations, HMOs, typically require members to choose a primary care physician and get referrals for specialist care, which is a key feature distinguishing them from other managed care plans. A 67-year-old retiree named Frank is concerned about prescription drug costs and wants to know which part of Medicare he should enroll in to receive prescription drug coverage. Is it A. Medicare Part A, B. Medicare Part D, C. Medicare Part B, or D. Medicare Supplement, Medigap? The correct answer is B. Medicare Part D. Medicare Part D is specifically designed to provide prescription drug coverage for Medicare beneficiaries, addressing Frank's concern about medication costs. When enrolling her young child in a government health program, Lisa learns her family's income is too high for Medicaid, but too low to afford private insurance. Which program is designed to help families in her situation? Is it A. Medicare, B. Medicaid, C. Children's Health Insurance Program, CHIP, or D. TRICARE? The correct answer is C. Children's Health Insurance Program, CHIP. The Children's Health Insurance Program, CHIP, is intended for families who earn too much for Medicaid but cannot afford private insurance, making it the right choice for Lisa's child. A small business owner wants to offer employees a managed care plan that allows them to see out-of-network providers without a referral, though at a higher cost. Which plan best fits this need? Is it A. Health Maintenance Organization, HMO, B. Exclusive Provider Organization, EPO, Point of Service, POS plan, or D. Preferred Provider Organization, PPO? The correct answer is D. Preferred Provider Organization. Preferred Provider Organizations, PPOs, allow members to see out-of-network providers without referrals, though members pay more for out-of-network care, matching the business owner's requirements. After losing his job, Tom applies for Medicaid but is denied due to his state's eligibility rules. Which federal law gives states flexibility to expand Medicaid eligibility to more low-income adults? Is it A. Affordable Care Act, ACA, B. COBRA, C. HIPAA, or D. ERISA? The correct answer is A. Affordable Care Act, ACA. The Affordable Care Act, ACA, allows states to expand Medicaid eligibility to more low-income adults, providing flexibility in coverage that could affect Tom's eligibility. After being diagnosed with a chronic heart condition, Mr. Patel wants to minimize his out-of-pocket costs and is considering enrolling in a government health program that limits his annual expenses and provides coverage for hospital stays, doctor visits, and preventive care. Which part of Medicare would best meet his needs? Is it A. Medicare Part A, B. Medicare Part C, Medicare Advantage, C. Medicare Part B, or D. Medicare Part D? The correct answer is B. Medicare Part C, Medicare Advantage. Medicare Part C, also known as Medicare Advantage, combines hospital, medical, and often prescription coverage, and typically includes an annual out-of-pocket maximum, which helps control costs for chronic conditions. Health policy provisions and cost containment. After being hospitalized for 3 days, Maria receives a bill showing her health insurance covered most costs, but denied payment for a private room. So which policy provision most likely explains this limitation? Is it A, grace period, B, limitations and exclusions, C, reinstatement clause, or D, coordination of benefits? The correct answer is B, limitations and exclusions. The limitations and exclusions provision in health insurance policies often restricts coverage for private rooms, unless medically necessary, explaining why Maria's insurer denied that portion of the bill. When Tom files a claim for a surgical procedure, his insurer applies a cost containment feature that requires him to obtain approval before the surgery. So which provision is being enforced? Is it A, guaranteed renewability, B, waiver of premium, C, pre-authorization requirement, or D, conversion privilege? The correct answer is C, pre-authorization requirement. Pre-authorization, or prior approval, is a cost containment provision requiring the insured to get insurer consent before certain procedures to control unnecessary costs. Jenna's health plan requires her to pay a fixed amount each time she visits her doctor, so which cost containment method is being used in her policy? Is it A, copayment, B, elimination period, C, coinsurance, or D, benefit maximum? The correct answer is A, copayment. A copayment is a fixed fee paid by the insured for each service, helping control costs and discourage unnecessary visits, which matches Jenna's experience. After switching jobs, David is allowed to continue his previous employer's group health insurance for a limited time by paying the full premium himself. So which policy provision enables this option? Is it A, time limit on certain defenses, B, free look period, C, non-forfeiture auction, or D, continuation of coverage? The correct answer is D, continuation of coverage. The continuation of coverage provision, such as COBRA, allows former employees to keep group health insurance temporarily by paying the full premium themselves. When Priya's health insurance claim is denied because she failed to notify the insurer within the required time after her hospital stay, the most relevant policy provision to this denial is the notification provision. Is it A, notice of claim, B, entire contract clause, C, misstatement of age, or D, legal actions provision? The correct answer is A, notice of claim. The notice of claim provision requires timely notification to the insurer after a covered event, and failing to do so can result in denial of benefits, as in Priya's case. After being referred to a specialist by her primary care physician, Linda learns her health insurance will only cover the visit if she follows the referral process outlined in her policy. So which cost containment provision is being applied in this situation? Is it A, pre-existing condition exclusion, B, coordination of benefits, C, gatekeeper provision, or D, guaranteed renewability? The correct answer is C, gatekeeper provision. The referral process is a key feature of managed care plans, such as health maintenance organizations, HMOs, which use gatekeeping to control costs by requiring primary care approval before specialist visits. Let's move into annuities and retirement. These realistic scenario-based questions will help you apply key retirement and annuity concepts while preparing you for the types of questions you'll see on the licensing exam. Annuities. Maria, age 60, wants to ensure she receives a guaranteed income for life and is considering purchasing an immediate annuity with a lump sum from her retirement savings. Which feature of an immediate annuity best addresses her concern about outliving her assets? Is it A, lifetime income payments, B, flexible premium contributions, C, market-linked returns, or D, deferred payout period. The correct answer is A. Lifetime income payments. Immediate annuities provide a guaranteed stream of income for life, directly addressing the risk of outliving assets, which is Maria's primary concern. After retiring, John selects a joint and survivor annuity to provide income for both himself and his spouse. What is the primary advantage of this annuity type in their situation? Is it A. Higher initial monthly payments? B. Continued income for the surviving spouse? C. Guaranteed return of premium? Or D. Inflation-adjusted payments? The correct answer is B. Continued income for the surviving spouse. A joint and survivor annuity continues to pay income to the surviving spouse after the first annuitant dies, ensuring financial security for both partners. Samantha, age 45, wants to accumulate funds for retirement and is considering a deferred annuity. What is a key benefit of choosing a deferred annuity for her long-term savings? Is it A. Immediate access to funds without penalty? B. Guaranteed lifetime income starting now? C. Tax-deferred growth of earnings? Or D. No surrender charges for early withdrawals? The correct answer is C. Tax-deferred growth of earnings. Deferred annuities allow earnings to grow tax-deferred, meaning Samantha will not pay taxes on gains until she begins withdrawals, enhancing her long-term savings potential. When reviewing his variable annuity statement, David notices that his account value fluctuates with the performance of underlying investments. What risk is David primarily exposed to with this type of annuity? Is it A. Longevity risk? B. Interest rate risk? C. Liquidity risk? Or D. Investment risk? The correct answer is D. Investment risk. Variable annuities expose the owner to investment risk, meaning the account value can rise or fall based on the performance of the chosen investment options. Linda is considering adding a period-certain option to her life annuity so that if she dies within 10 years, her beneficiary will continue to receive payments for the remainder of that period. What is the main purpose of this annuity feature? Is it A. Guaranteeing a minimum payout period? B. Maximizing monthly payment amounts? C. Providing inflation protection? Or D. Allowing for lump sum withdrawals? The correct answer is A. Guaranteeing a minimum payout period. A period-certain option ensures that payments will continue to a beneficiary for a minimum period, protecting against the risk of early death and loss of principal. Qualified retirement plans and retirement concepts. Maria, age 45, wants to maximize her retirement savings and is considering contributing to her employer's 401k plan. But she is unsure if her contributions will be taxed when she withdraws the money at retirement. What is the tax treatment of her 401k distributions when she retires? Is it A. They are tax-free because contributions were made with after-tax dollars? B. They are taxed as ordinary income upon withdrawal? C. Only the investment earnings are taxed, not the original contributions? Or D. They are taxed at a special lower capital gains rate? The correct answer is B. They are taxed as ordinary income upon withdrawal. 401k contributions are made pre-tax, so distributions are fully taxable as ordinary income when withdrawn at retirement, reflecting deferred taxation on both contributions and earnings. After retiring at age 62, John wants to start receiving income from his fixed annuity and is concerned about outliving his savings. Which annuity payout option would best address his concern about guaranteed lifetime income? Is it A. Lump sum payout? B. Period certain payout? C. Life only payout? Or D. Joint and survivor payout? The correct answer is C, life-only payout. A life-only annuity payout option provides guaranteed income for as long as John lives, addressing his concern about outliving his savings. Samantha, a small business owner, wants to set up a retirement plan that allows her to make flexible annual contributions for herself and her employees. Which qualified plan best fits her needs? Is it A, defined benefit pension plan, B, traditional IRA, C, 403(b) plan, or D, SEP IRA? The correct answer is D, SEP IRA. A SEP IRA allows employers to make flexible, discretionary contributions each year, making it ideal for small business owners with variable income. David, age 73, has a traditional IRA and has not taken any withdrawals this year. What is the consequence if he fails to take his required minimum distribution, RMD, by the deadline? Is it A, he will owe a 50% penalty tax on the amount not withdrawn, B, his IRA will be automatically closed by the financial institution, he will lose all tax-deferred growth on his IRA, or D, he will be required to convert his IRA to a Roth IRA? The correct answer is A, he will owe a 50% penalty tax on the amount not withdrawn. If David fails to take his RMD, the IRS imposes a 50% excise tax on the amount not withdrawn as required. Let's finish with regulation, ethics, and producer responsibilities. These realistic scenario-based questions will test your understanding of the laws, ethical standards, and professional responsibilities every insurance producer is expected to know for the licensing exam. Insurance regulation. After receiving a complaint from a client about misleading policy information, insurance producer Maria is contacted by the state insurance department for an investigation. What is Maria's regulatory obligation in this situation? Is it A, refuse to answer questions until consulting her agency's legal counsel, B, promptly provide all requested information and cooperate with the investigation, C, only respond to the complaint if the client provides written consent, or D, ignore the inquiry unless she receives a formal subpoena? The correct answer is B, promptly provide all requested information and cooperate with the investigation. Producers are required by law to cooperate fully with regulatory investigations, providing requested information and documentation promptly to ensure compliance with insurance regulations. Insurance agent Tom receives a cash payment for a new policy and considers depositing it into his personal account before forwarding it to the insurer. What regulatory rule applies to Tom's handling of client funds? Is it A, he may deposit the funds in his business account as long as he forwards them within 30 days? B, he can hold the cash until the policy is issued, then send it to the insurer? C, he must place the payment in a separate trust account and forward it to the insurer? Or D, he can return the cash to the client and request a check instead? The correct answer is C, he must place the payment in a separate trust account and forward it to the insurer. Producers must keep client funds in a separate trust or fiduciary account and never commingle them with personal or business funds, ensuring proper handling and accountability. While advertising a new life insurance product, agency owner Lisa includes a testimonial from a client without their written consent. What ethical and regulatory issue does this raise? Is it A, it violates advertising regulations requiring written client consent for testimonials? B, it is acceptable as long as the testimonial is accurate and positive? C, it is only an issue if the client complains to the regulator? Or D, it is allowed if the testimonial is anonymous and does not reveal personal details? The correct answer is A, it violates advertising regulations requiring written client consent for testimonials. Using client testimonials in advertising without written consent violates both ethical standards and insurance advertising regulations designed to protect consumer privacy and prevent misleading promotions. During a policy review, producer Kevin discovers that his client's application omitted a significant medical condition. What is Kevin's regulatory responsibility upon learning this information? Is it A, ignore the omission, since the policy has already been issued? B, advise the client to update their medical records with their physician only? C, wait until the next policy renewal to address the omission? Or D, notify the insurer immediately about the omitted medical condition? The correct answer is D, notify the insurer immediately about the omitted medical condition. Producers are obligated to promptly report material misrepresentations or omissions to the insurer to ensure accurate underwriting and regulatory compliance. A newly licensed producer, Sarah, is unsure whether she needs to complete continuing education before her license renewal. What is her regulatory obligation regarding ongoing education? Is it A, she is exempt from continuing education requirements for her first renewal? B, she must complete the required continuing education hours before renewing her license? C, she only needs to complete continuing education if she changes employers? Or D, she can delay continuing education until after her license is renewed? The correct answer is B, she must complete the required continuing education hours before renewing her license. Most states require producers to complete a specified number of continuing education hours before each license renewal to maintain their authority to sell insurance. Producer licensing and fiduciary responsibilities. While reviewing her monthly commission statement, licensed producer Maria notices a client has mistakenly sent her a premium payment instead of sending it directly to the insurer. What is Maria's fiduciary responsibility in handling this client's funds? Is it A, deposit the premium into her personal account and pay the insurer later? B, return the premium to the client and ask them to resend it to the insurer? C, immediately forward the premium to the insurer and keep records of the transaction? Or D, hold the premium until the next billing cycle before sending it to the insurer? The correct answer is C, immediately forward the premium to the insurer and keep records of the transaction. Producers must promptly forward client premiums to the insurer and keep client funds separate from personal or business accounts to fulfill fiduciary duties and avoid commingling, which is prohibited by insurance regulations. After moving to a new state, licensed producer Kevin continues selling life insurance policies for 3 months before applying for a non-resident license in his new state. What regulatory issue does this scenario illustrate? Is it A, Kevin is allowed to sell policies for up to 6 months before applying for a new license? B, Kevin is violating state insurance regulations by selling without a license in the new state? C, Kevin can rely on his previous state's license indefinitely? Or D, Kevin only needs to notify his old state of his move, not the new state? The correct answer is B, Kevin is violating state insurance regulations by selling without a license in the new state. Producers must be properly licensed in each state where they sell insurance. Selling without a valid license in the new state is a regulatory violation and may result in penalties or loss of license. Insurance producer Linda is offered a bonus by an insurer for each policy she sells, but the bonus is not disclosed to clients. What ethical concern does this situation raise under producer compensation regulations? Is it A, Linda must disclose the bonus to clients to avoid conflicts of interest? B, Linda can accept the bonus without disclosure if it is a standard industry practice? Linda should refuse all bonuses from insurers to avoid ethical issues? Or D, Linda only needs to disclose bonuses if clients ask about her compensation? The correct answer is A, Linda must disclose the bonus to clients to avoid conflicts of interest. Undisclosed compensation arrangements can create conflicts of interest and violate ethical standards requiring transparency with clients about producer compensation. Producer Sam's license has expired, but he continues to solicit new insurance business for 2 weeks before renewing it. What is the likely regulatory consequence of his actions? Is it A, Sam's renewal will be processed without issue since he renewed within a month? B, Sam can retroactively apply his renewed license to the period he was unlicensed? C, Sam will only receive a warning if this is his first offense? Or D, Sam may face fines or disciplinary action for conducting business while unlicensed? The correct answer is D. Sam may face fines or disciplinary action for conducting business while unlicensed. Soliciting insurance without a valid license is illegal and can result in disciplinary action, including fines, suspension, or revocation of the producer's license. Unfair trade practices and consumer protection. After a client files a complaint about misleading advertising, an insurance producer is found to have exaggerated policy benefits in a brochure. Which regulatory action is most likely to follow in this situation? Is it A, the producer will be required to retake ethics training only? B, the client's policy will be automatically canceled? C, the producer may face fines, suspension, or license revocation? Or D, the insurance company will be dissolved by regulators? The correct answer is C. The producer may face fines, suspension, or license revocation. Misleading advertising is considered an unfair trade practice, and regulators may impose penalties such as fines, license suspension, or revocation to protect consumers and uphold ethical standards. A producer offers a client a free vacation if they purchase a life insurance policy and the client accepts. What unfair trade practice has the producer committed in this scenario? Is it A, rebating, B, twisting, C, defamation, or D, churning? The correct answer is A, rebating. Offering inducements not specified in the policy, such as gifts or vacations, is considered rebating and is prohibited to ensure fair competition and consumer protection. During a policy review, a producer encourages a client to cancel their current health insurance and buy a new policy by falsely claiming the new plan is required by law. Which unfair practice is demonstrated here? Is it A, rebating, B, twisting, C, boycotting, or D, coercion? The correct answer is B, twisting. Falsely representing policy benefits or requirements to induce replacement is known as twisting, which is prohibited to protect consumers from deceptive sales tactics. A consumer files a complaint after discovering their insurance application was altered by the producer without consent to secure a lower premium. What is the most appropriate regulatory response to this violation? Is it A, the producer will be required to apologize to the client? B, the client will be required to pay the correct premium? C, the insurance company will issue a warning to the producer? Or D, the producer's license may be revoked by the regulator? The correct answer is D, the producer's license may be revoked by the regulator. Altering an application without the applicant's knowledge is a serious ethical and legal violation, and regulators may revoke the producer's license to protect the public and maintain trust in the industry.
Thanks for watching. If you found this exam review helpful, be sure to subscribe for more real-world practice and topic-focused study videos. And visit Birdsy.ai to start your free trial of Birdsy, your AI-powered study partner.